When you picture a Wall Street trader, you probably imagine someone screaming buy, buy, buy into a phone, betting millions on a gut feeling. But the reality, it's completely different. Hi, my name is Sunil and I help finance professional to become a quant. Today I'm going to break down the three distinct type of traders: the hedge fund trader, high frequency trader, and investment bank trader. Because the truth is, they play completely different game and they make money in a completely different way. This is the video I wish existed when I was trying to break into this industry. So let's get started. Let's start with the one that surprises most people, that is hedge fund. Most people think that a trader at a hedge fund is the one calling the shots. This is actually a myth. In a hedge fund, we split the front office into two camps: the people who generate the trade idea and the people who execute it. At the top, we have the chief investment officer and the portfolio manager, supported by analysts. These guys are the architect. They do the modeling, the research, and decide we need to buy 10 millions worth of Apple stock. Then they hand it over to the execution trader. If you get hired as a trader at a hedge fund, this is usually your job. You aren't deciding what to buy, you're deciding how to buy it without tripping the price against yourself. The portfolio manager might say, get this done fast or work this order throughout the day. Your job is to call up the banks like JP Morgan, Goldman Sachs, or use algorithm to get the absolute best price. The portfolio manager chases the alpha, you chase the best execution. Now, before we talk about the other two types of trader, you need to understand one core concept: the difference between a market maker and a market taker. Imagine an order book. The market taker, this is usually the hedge fund, they want to buy Apple stock now because they think it will go up. They take liquidity off the book, they pay the spread. On the other side, we have the market maker. This is the person on the other side of the trade. They aren't betting the stock will go up or down, they are just willing to buy and sell at the same time. Think of a currency counter at the airport. They will always buy you a dollar and they will always sell you a euro. They don't care if the dollar crashes tomorrow. They make their money on the gap between the buy price and the sell price. That gap is the spread. Why does this matter? Because the next two type of traders are market maker. This brings us to the investment bank trader, the sell side. If the hedge fund wants to buy 1,000 shares of Apple, the investment bank is the one selling it to them. Investment bank traders are essentially that currency counter at the airport. Their main job is liquidity provision. They use the bank massive balance sheet to take the other side of the trade. If they sell Apple stock to a client, the bank is now short. They have a risk. So they have to immediately hedge that risk by buying some share somewhere else. They don't want to bet on the direction. They want to capture the spread and move on. So unlike the hedge fund trader, an investment bank trader is responsible for their own P&L. But that profit comes from managing the flow and spread, not guessing if a stock will move. Finally, we have a high frequency trader. Firms like Jane Street, Citadel Security, or flow traders. HFT are a bit of a hybrid, but the majority act as an electronic market maker. They do exactly what the investment banker do, providing liquidity, but they do it algorithmically and at a very high speed. An HFT trader job isn't picking stock, it's monitoring algorithm. They are constantly quoting bid and offers on exchanges. Here's the insider detail most people don't know. HFTs often make money through exchange rebate. Exchange like NYSE, Nasdaq, they pay these firms to provide liquidity because it makes the exchange stable. So even if an HFT loses a tiny bit on the trade itself, they might be profitable because of the rebate check from the exchange. So to recap, hedge funds, the portfolio manager predict the future, the execution trader buys the ticket, market maker. Investment bank, the supermarket, they provide the liquidity and earn the spread, market maker. HFTs, the speed demons, algorithm, market maker, who earns from spread and rebates. I hope this clears up the confusion. If you want me to go deep dive into any specific one of these roles or explain the interview process, comment it down in the comment section.